Hi everybody, this is Alan Ellman, the Blue Collar Investor. Today we're going to discuss the Ellman System Options Calculator and specifically the single tab of the calculator. We use this tab when we've selected a stock that's passed all of our system screens, including the fundamental and technical screens. We now want to take that stock and put it into our portfolio. We just don't know which strike price to use, in the money, at the money, or out of the money. To make that decision, we need to go to our options chain. Our options chain will give us the information that we could feed into the calculator. Today we're going to look at a stock called Kirkland's Inc., ticker symbol KIRK, and the price is currently trading at $17.37. Now, this is January 1st, 2010, so we're only 2 weeks away from the January expiration. So what we're going to do is we're going to look at the February expiration. So we scroll down to February and we take a look at the strike prices that are available. Since the stock is trading at $17.37, we'll look at the 15, the $17.50, and the $20 out of the money strike. Now, we look at the bid column to see how much cash those strikes are going to generate. And it's $270 for the 15 strike, $115 for the $17.50 strike, and 35 cents per share or $35 per contract for the $20 strike. If you'll notice, there's a big discrepancy between the bid and the ask, and oftentimes we could do what we call playing the bid-ask spread to get an even higher bid price when we sell the options. For more information on that, go to the blog link of my website and scroll down the left-hand side until you see bid-ask spread. Click on that and you could read an article that I wrote regarding this subject. Now, one additional thing that I want to show you on the options chain is all the way to the left we have the option symbols. And you could see QQJ are the root symbols, and then we have BC, BW, and BD for the three strike prices. And that, folks, is pretty much all the information you need to get to the options calculator. And the calculator has two sides to it, and the left side is where you feed the information in. I first want to show you, though, at the bottom of the left side, you have the information on the four tabs you can click on. The intro tab, which gives information, the single tab, which we're going to look at today, and the multiple and what now tabs, which we focus on another time. And if you take a look at the left side, you'll see a blue area, and that's where you feed in the information that we just gleaned from the options chain. So we put in the stock name, the stock ticker, and the current price of $17.37. We also add in the option symbols that we alluded to before, and the strike prices. Now, they all have the same expiration date of February 19th. However, you could put in January or March expirations too. You have up to 4 choices to select. And then finally, you put in your price per share of $270, $115, and 35 cents for the 20 strike. And that's all information gleaned from the chain. And now what we do is we scroll over to the right side of the spreadsheet, and you'll see that the right side of the spreadsheet is broken down into thirds. The top third is the information that we just entered into the blue areas on the left side. And the middle third will actually give you 3 columns, and those 3 columns are the 15 strike, the 17.50 strike, and the 20 strike. You'll see today's date is put in, January 1st, which gives you 49 days until expiration. The cost of the shares are all the same, $17.37, and the proceeds per contract $270, $115, and $35. Underneath that, we have out of the money or in the money. The only one that's in the money is the 15 strike, which is in the money by $2.37. And the 17.50 is slightly out of the money, $13, almost negligible, 0.7%. and the out of the money, very significant $263, which would garner us an additional 15.1% if the stock went from 1737 past the 20 strike. Okay, now downside protection. The only option strike that has downside protection is the 15 strike, which gives you downside protection of $237 from 1737 down to the 15 strike, or 13.6%. No downside protection for the at-the-money strike. Once again, slight upside protection potential of 0.7%. And the 20 strike gives you tremendous upside potential of 15.1%. That takes care of the middle section. And finally, we have the lower section, which gives you the return on the various outcomes. And you see that the $15 strike will give you a return of $270, but we need to deduct the intrinsic value of $237 because we bought the stock for $17.37, agreed to sell it for $15. So we need to deduct that loss. Gives us a total profit of $33, which is the actual time value of the option premium. And if we divide that by our cost basis, which we actually bought down by the intrinsic value amount to $15 a share. And if you need a further detailed explanation on that, look in my book, Cashing in Uncovered Calls, in the Calculations chapter, and you'll have an understanding of how that works. But for now, suffice it to say that we're going to use $1,500 as our cost basis for the in-the-money strike, and $33 is our profit, which will give us a 2.2% 49-day return, or 16.4% annualized. Now, the at-the-money 1750 strike will give us a return of $115, and that represents a 6.6% 49-day return, with the possibility of another $13 or 0.7%, which would give us a 7.3% 49-day return, or 54.4% annualized. And finally, we go to the $20 strike, the out-of-the-money strike, which gives us a $35 per contract return on a cost basis of $17.37. That represents a 2.0% 49-day return. And if we get the upside potential of 15.1%, that would give us a 17.1% 49-day return, or a whopping 127.4% annualized return. So there you have it. If you are conservative, concerned about the market or the stock technicals, you would opt for the in-the-money strike, which gives you that 13.6% downside protection. If you're bullish, you would go with the out-of-the-money $20 strike, where you can get a possible 17.1% 49-day return. And if you're somewhere in between, you would go for the at-the-money, where you get the 6.6% return on your option premium, but no downside and very little upside. So the single tab will give you all the information that you need to guide you to a decision. For more information, visit my website at www.thebluecollarinvestor.com or email me directly at alan@thebluecollarinvestor.com. Thanks for listening, and